Welcome, everybody. My name is Fabio Petti. I'm a Deputy Head of Group Investment Strategy. I'm here with Alessandro Caviglia, our Chief Investment Officer for Italy, and Marco Valli, our Chief Economist. We just closed our Group Investment Committee, where, of course, we discussed potential implications stemming out from the crisis in the Middle East. And what we can see is basically two sets of scenarios. One, that is what the market is currently assuming, is a crisis that can last a couple of weeks, basically within the month of March. And another one that instead sees a potential widening of this conflict, either in terms of time or in terms of geographies. And that would be massive implication in terms of oil price and as a consequence in terms of macroeconomics. What will be crucial to keep in mind and to observe, to understand in which of the two scenarios we're in, is on one end, the price of energy that can ultimately affect inflation, and that would be extremely important for Donald Trump to look at on the back of the fact that we are approaching November election. You know that this is a crucial factor that Trump has to look at because it's part of what basically has lowered the possibility for the Democrats to win the past election on the back of the COVID crisis. So we think that this is something that Donald Trump will really look at it. Second level that is pretty connected with the first one is the level of treasury yield. We think that a level above 4.5% can be a trigger point. This happened also last year, that I think you remember that immediately after Liberation Day, we reached progressively that level, and this basically changed the narrative in Trump with the softening of the discussion you were having in setting the tariff. So it's likely also act as a trigger point for them due to the refunding of the huge debt the US Treasury has. The third point is the evolution of American US share price. We saw resiliency so far, but for sure that if we're going to see in the future, in the coming weeks, prolonged withdrawal and potential drawdowns in this very important asset class for the American citizenship, again, that would be a turning point for Donald Trump. On the back of this, I would ask Marco Valli, can you give us a little bit of color on the potential implication that you see for the US market in the two scenarios?
Okay, starting from the US economy, the idea is that obviously the US is independent when it comes to energy provision. Okay, they are net exporters of energy to the rest of the world, so they are definitely better off than Europe. If we are indeed in a scenario where the conflict lasts just a few weeks and then it starts fading, and the energy prices are peaking basically around now and then start declining, then I see no reason to think that the growth outlook for the US would be different. As a matter of fact, we have not changed our GDP forecast for the US. We are confirming almost 2.5% growth for this year and about 2% growth for 27. That remains unchanged. There will be a bit more of inflation, but not by a lot. So we're speaking about a few tenths of a percentage point. And overall, what does this mean for monetary policy? I think it means that the Fed, yes, they are dealing with a bit higher inflation already starting from levels that are above target, but ultimately probably the Fed still has a room to come down with interest rate, but with just one interest rate cut. So basically we confirm our current central forecast. If we move instead in the adverse scenario with the much higher energy prices that stay for a longer period of time, then this obviously has material negative implications also for the US, although not as bad as in Europe. For growth, I think we could expect forecast to come down by about 0.5 percentage point on a cumulative basis over the 2 years, which basically means that 2027 would move from 2.5 to 2. I think still quite good numbers, right? So it's definitely not a negative or a very bad scenario. But we will have more inflation. probably around a full percentage point more, which comes on top of an already high level of inflation. What does this mean for the Fed? Basically, it means that the Fed will probably not be able to cut interest rates further, despite the situation of the labor market is getting a bit more shaky. Interest rates steady, and with a risk that if longer-term inflation expectations start drifting higher, the Fed might even have to actively consider rate hikes.
Alessandro, on the back of this scenario, basically, Marco is telling us that overall, US economy is in a good shape also to withstand such a situation. And as a tangible result, we saw the recent market performance on equity in the US. So considering that we had already last year an underweight position in the fixed income market for US, what is your view on the US equity market and what role it plays in the overall global portfolio that we build?
Obviously, US equity markets is fundamental for our construction process because we build global equity portfolios. Global for us means 55% on US equity, 25% on emerging market equities, 20% on Europe. So basically, the resilience, the strength of the US market is positively impacting our portfolio, which has a defensive stance. And we have also to consider that there is a currency implication. It's true, we suggest to hedge part of the equity exposure, but basically our US position is mainly in US dollar, and US dollar is appreciating against the euro. We maintain a view that US dollar will gradually and orderly weaken versus euro, but in this particular moment, the US dollar is acting as a hedge, a natural hedge. And we stick also to our long position on emerging market equities. And from this derives another additional relief factor. Basically, two of the most relevant currencies of emerging market equities are Hong Kong dollar and Chinese renminbi. And they are strictly correlated to the US dollar. So this led to an appreciation of these currencies versus euro. Finally, there is a component on the equity side that is helping us, and we build a small cash reserve during our first week of the year. And we build that with a twofold purpose. Basically, we still think this will be a good year in terms of financial returns, but we know that temporary corrections, turmoil are quite probable. And so we build this cash reserve in order to protect us during this period. As an example, on a 50% profile, we have a 46% equity exposure. The second objective is once the situation stabilizes and we get more visibility, we will put these cash reserves into work to regain our previous equity exposures and build on our long-term potential return.
Thank you, Alessandro. Let's move on the other side of the ocean, Marco. Let's talk about Europe and its dependency for external supply in terms of energy. So I'm expecting the heat will be much more relevant for the Eurozone.
Yes, definitely. It's important to say, however, that before the shock, the Eurozone economy was showing resilience. So the shock hits when the economy was, however, increasingly resilient and increasingly showing signs of strengthening of the investment cycle, which I think is a good position to start with. Although overall growth in Europe, as we know, is quite moderate. So baseline scenario: we have a relatively quick resolution of the conflict. Energy prices start coming down. What does it mean for our forecast? Basically, we have to take down the forecast, but only very moderately so. So we are shaving about 0.1% of GDP growth for this year and for 27, which basically leaves us with a growth rate of just below 1% for this year and a bit above 1% for next year. So all in all, no major changes on the growth outlook. There is more change on the inflation side because previously we were expecting a prolonged period of below 2% inflation. That's no longer true. Our inflation forecast for this year moves to 2.5%, with inflation seen coming down to 2% in 27 as the shock fades. What does this mean for monetary policy? The market has been shifting in terms of risk assessment. Up to before the strikes started, the market was pricing in a probability of the next move by the ECB being a cut. This has been reversed. Now the market is betting that the next move will be a hike, and probably already by the end of the year. Do we share this assessment? No, because in this scenario where the spike in energy prices is temporary, yes, we will have more inflation, but then ultimately inflation will converge back towards the ECB target in 27. And unless we see a de-anchoring of inflation expectations, then I think that the ECB can remain on hold throughout 2026. If we end up, unfortunately, in the more adverse scenario, then we have to expect material changes both in the growth and inflation outlook. In terms of growth, we would cut our GDP forecast by around a full percentage point on a cumulative basis between 26 and 27, which would leave us with the growth numbers of just above half a percentage point in both years. It's not a disaster, it's not a recession, but it's definitely a clear weakness. And in terms of inflation, we would probably have to increase our inflation forecast for this year north of 3%, okay? And possibly by the end of this year, inflation rates would be around 4%. And then next year, the average inflation rate would probably be at least 2.5%, but probably even higher. Implications for monetary policy, different from what we have in, say, the more benign central scenario, because with such high rates of inflation and with the increased likelihood that inflation expectation might start moving upward, then I think that the risk of the ECB having to respond with the rate hikes would definitely increase at a time when economic activity is already under pressure. So that would definitely not be a good scenario for the Eurozone.
Alessandro, on the back of this scenario, basically inflation risk and risk tilted on the upside as far as rates are concerned. What are the implications for our sovereign portfolio, European one, and in general on fixed income?
Yes, the macroeconomic landscape in Europe is of the essence for us because we are euro-based fixed income investors. We invest into euro government, euro corporate investment grade, and we have also satellite position on emerging market debt. Basically, yields are slightly moving up, spreads are widening because of the increased risk in inflation and of the, let's say, correction in European equity markets. But at the end, on the fixed income side, we are convinced that these are temporary losses because basically we build very well diversified portfolios using even funds and ETFs, for example, on corporate, on emerging market debt. So we have no specific risk. And once situation will stabilize, we will start to gain back lost ground because basically we simply will start from a higher yield to maturity, from a higher carry level, which is our line of defense in case the situation worsen. Well, basically last year we built a short and underweight position on government bond on the back of the fact that deficits and debt were increasing in the developed countries. Now there is an additional reason. In the worst case scenario, we will have higher long-term inflation expectations, and this will have a negative impact, especially on the long end of the government curve, the 10 years, the 30 years. So that is why we stick to our underweight position on government, and we focus our exposure on the short and intermediate part of the curve.
Thank you, Alessandro. So basically, we are confirming our overall strategic asset allocation stance that is proving to be resilient in this very difficult period of time. Situation is very fluid, both on the military ground and on the financial markets, so we will keep you posted and updated through our official website of UniCredit and also on the UniCredit Investment Institute website. For the time being, I thank Alessandro and Marco for their speech and you for listening to us. See you on the next one.